It's Fed Day and futures are higher. 30 minutes until the start of cash trading. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Tesla is leading gains among the Magnificent Seven stocks after Elon Musk's EV maker won a license to carry passengers in California, a bid to challenge Uber and Waymo. NVIDIA CEO Jensen Huang announced a raft of partnerships with companies including Disney, Google's DeepMind, and General Motors, but failed to wow investors. And Morgan Stanley is planning to fire about 2,000 people in the first major workforce reduction under Chief Executive Officer Ted Pick. Plus, it is Fed Day. Let's take a look at where markets are trading. I say that only because you're going to see very light volume today. We do see positive trades in futures. S&P futures up almost 0.25%. NASDAQ futures up about 0.33% because there is so much tech news today. But you can see that the 10-year yield still holding at that 430 level right now at 428.11. And you won't see a lot of volume in these markets until after that decision. A lot of times traders will turn off the computers and let the humans decide until after the statement is released, maybe even during the press conference. Sonali, what are you watching?
Yeah, a few things. We're watching Tesla, of course, Matt. You're keeping an eye on that, too. We were talking about it. They have approval to carry passengers in California. It's paving the way for ambitions to branch out as a ride-hailing service. The company plans to offer a paid autonomous taxi service in Austin in June. Still, you only have it moving modestly this morning. Also moving modestly, I'm watching NVIDIA. Very important here. We're going to dive right into it because shares modestly higher this morning after a lackluster keynote speech from CEO Jensen Huang at the chip conference. Just yesterday was his conversation, and he announced the next lineup of Blackwell chips and partnerships with a number of companies, including General Motors, T-Mobile, and Dell. But here's the thing, it was down 3.4% or more by the end of yesterday. So let's call this a breather. Both Jensen Huang and investors are bullish on NVIDIA's future, though. Take a listen.
General purpose computing has run its course, and that we need a new computing approach. And the world is going through a platform shift.
You're seeing demands accelerating, and I think when you look at laying out physical AI, Rubin, autonomous, robotics, I mean, this is essentially Jensen saying, it's our world, everyone else paying rent when it comes to AI.
NVIDIA is definitely the best company in the world, and so it trades at 40 times earnings today. I can buy NVIDIA with 75% earnings growth at 40 times earnings. This is the cheapest of the Mag 7 or the big caps or the tech companies, and it's growing the fastest.
I think the street is sort of misinterpreting what I believe is just so bullish in terms of the long-term outlook.
I've said before that I expect data center build-out to reach $1 trillion. And I am fairly certain we're going to reach that very soon.
All right, we are very interested in what NVIDIA has to say, but it really didn't seem to drive a recovery in the stock. Yeah, we see it bouncing a little bit, right, in the aftermarket, in the pre-market trade. But after a 3.5% drop yesterday, it doesn't seem like they did enough.
We didn't regain the losses.
Yeah.
And it really, this is a market that's just taking a breather. It's still looking for that low. And so until they find it, the conviction trades are hard to come by. But we did talk to Kathy Wood. She's buying some stocks. We're going to focus on in a little bit. She really believes in a revival, obviously, of Tesla. But I want to bring in Bloomberg Intelligence senior semiconductor analyst Kunjan Sobhani to talk about NVIDIA and really all those partnerships that they announced. It doesn't seem like Jensen Huang's really got his mojo. Is it him or is it the market?
I think at this point, it seems like a market. I mean, look, they announced everything and more than what we were expecting, but they didn't give enough of a measurable and quantifiable catalyst for a near-term upside, which investors have just gotten used to with this company. From a long-term perspective, they gave a lot of data points, an updated roadmap, innovations across the board, whether it's networking, GPU, a lot of partnerships with enterprise, which sort of get overlooked, but that sets the stage for a 27 and beyond strong ramp and diversification out of the cloud guys.
What about the negative sentiment that exists today? I mean, how much of this is because of where NVIDIA is still trading, and how much of it is due to other forces, worried about tariffs and even reactionary moves by rivals or customers? There had been some talk yesterday about the Google Wiz deal and whether that signaled a different direction in terms of CapEx spend.
Yeah, so there's plenty of risk factors going on here, but I think the biggest risk we hear from investors is hyperscale capex sort of normalizing or taking a breather. We didn't see any signs of that. They're on keynote or talking to Jensen himself. Like, it looks like the DeepSeek has actually increased the urgency of the reasoning model and the inference need, which does drive higher number of tokens, means just more and more compute, which is good for NVIDIA. So we didn't see any of those risk factors. I think it's a combination of where the current de-risking is going on. And again, there was nothing new which the traders could go and execute immediately for the near term.
Wang said, according to the Wall Street Journal, that AI would require at least 100 times the compute that we expected even a year ago. Is that the case, Jon? I mean, is that how far your expectations have come in 12 months?
Well, definitely from a technology standpoint, it has increased in a rate that nobody expected, other than, I guess, Jensen. Is definitely the case, especially with the upcoming of the reasoning models like DeepSeek. We do see right now the number of tokens generated, which means the number of compute required has shot up.
So what about some of the use cases that he did bring to the surface here? One thing Matt and I have been talking about a lot on this program this week is humanoids. Love the idea of humanoids, but it would take a while to get there, wouldn't it?
Definitely, it will take a lot more while. And the one key thing to highlight is right now everyone's worried about with the monetization from all these investments in Gen AI, right? The humanoid investment will take even a longer time before you could start seeing real revenue stream come out of it. So that concern will even get further down the road when we get to that. But definitely the humanoid concept to get material revenues for NVIDIA, it's still many years out.
All right, Jon, thanks so much for joining us. I'm sure, going to be calling on you very often in the near future to talk more about what's going on with NVIDIA. Jon Sabani covers it for us at Bloomberg Intelligence, where he's a senior analyst. I'm looking at futures. As I said, you're going to see lighter volumes today, but we do see green arrows across the board. S&P futures up 0.25%, NASDAQ futures up 0.33% into that Fed meeting, and there's a lot to watch on Wall Street.
Yeah, certainly a lot to watch. You're watching Morgan Stanley come out. They say, according to our reporting here at Bloomberg, that they're planning to cut about 2,000 employees later this month across the firm, except for its financial advisors. That's about 15,000 people in those ranks. We do see a little bit of relief in Morgan Stanley shares. The idea here is to cut costs. Remember, things have not worked out on Wall Street as you would have thought they would. Citigroup we're also watching because they cut payouts to hundreds of top executives in the final round of a 3-year special bonus program. We're going to talk a lot more about this, but remember, all these banks are down on the year.
Yeah, it's interesting to see these cuts. Ted Pick has been there, for almost a year and a half now, right? And this could concern not only employees of Morgan Stanley, but also shareholders, because what does this mean about the bank's position?
You know, shareholders sometimes like it because it means that they're keeping a handle on costs, but I think who is going to be more concerned is actually rival banks' employees, because if Morgan Stanley goes first, then there's an open question on who comes next.
All right, I want to quickly mention that we've also seen a surge in Williams-Sonoma shares. Yeah. Obviously, kitchen equipment is a lot different than the banks that you use to manage your finances, but they came out with earnings minutes ago, and they said fourth quarter adjusted EPS was $3.28. We were only looking for $2.94, so beating by a long shot. And as a result, those shares up big in the pre-market. Watch them to bounce at the open. Also bouncing at the open, we're expecting Tesla to come back. The EV maker leading gains for all of the Mag 7 in the pre-market trade this morning. You've typed most U4 on your Bloomberg terminal and filter out for companies over $50 billion. It's the biggest gainer. Still ahead on the market, Sitara Sundar is going to join us from JPMorgan Private Bank, and Jose Rasco of HSBC Private Banking and Wealth Management will get their takes on this market into the Fed. This is Open Interest. get a look now at high interest, what's making headlines around the world from the Bloomberg terminal. The Turkish lira is trading at its lowest level on record, and the equities index is tanking there as well. President Erdogan's most prominent rival, Istanbul Mayor Ekrem İmamoğlu, is detained in a widening crackdown on the opposition. People familiar told Bloomberg that Turkish lenders sold around $8 billion midday to support the currency, but the equity markets are in Turkey among the worst performers in the world today. Ben & Jerry's is accusing its parent company Unilever of firing its CEO because of a dispute over the ice cream brand's social mission. The claim comes up in a legal complaint filed late Tuesday in the Southern District of New York. The company says Unilever has repeatedly threatened Ben & Jerry's personnel, including CEO David Stever, should they fail to comply with Unilever's efforts to silence the social mission, makers of Cherry Garcia. And turnaround for Tesla, at least for a day. The EV maker is leading pre-market gains among the Magnificent Seven stocks after the electric vehicle maker was granted approval for a ride-sharing service in California, at least the first step towards that and the first step towards competing with Uber and Waymo. We spoke with Kathy Wood yesterday and asked if she's buying the dip.
We've been buying Tesla and names that mimic Bitcoin and other crypto assets like Coinbase, like Robinhood, taking advantage of this risk-off period.
Tesla, certainly an interesting story lately. Dip buyers starting to come in after some steep sell-offs that we have seen. And one of them would be a ratings upgrade from Cantor Fitzgerald. Of course, that's a lot of interest for a lot of people because Cantor Fitzgerald, of course, is the company formerly run by Howard Lutnick, who is the current Commerce Secretary, who obviously has a new relationship with Musk today. Yeah,
interesting that they have an upgrade there to a buy. I actually looked at the A&R function, and if we can pull that up on the Bloomberg terminal, you'll see that there are 60 analysts covering Tesla, and 36 of them have buys. This is the maximized price target and actual price action, the 12-month price target in white, the price action there in yellow. And you can see that the price has dived below what the street is looking for.
It's lost half its value since its record high. I want to point out a catalyst that Cantor Fitzgerald is looking for, and that's June. They're looking for autonomous ride-hailing in Texas in June. So we'll see how that goes and see if June could serve as a catalyst.
Right, and that's an important distinction, right? Because that is going to be driverless, and the license that they've been granted in California is for a fleet of, I guess, taxis that are owned by Tesla but driven also by Tesla employees. And in fact, in this permit, they can only start with giving rides to Tesla employees. So it's a baby step, but it is one step in that direction.
The other thing they say, to be fair, is also valuation. And I think that that is also something a lot of people are considering. What is the new for valuations for these big tech stocks? I also want to point out another mover that you've been looking at because it's been fluctuating this morning. Williams-Sonoma with an earnings beat, but now down, I believe. It was up, now down about 5.9, almost 6%. This one's an interesting one to watch because you have had a cool down in the consumer on the lower income end of the spectrum. Williams-Sonoma is really expensive. And so a lot of people are watching, Matt, to see.
You mean the products, not the stock.
Correct. The products. I don't know how many aprons or kitchen towels you're buying there or heading to Pottery Barn as well. But a lot of people are watching whether the consumer is drifting. And that's why people are watching this as well.
Yeah, absolutely. Although they blew away fourth quarter expectations on profit, and they also raised their dividend more than expected. So it's interesting to see the stock down pre-market. We're also watching Boeing pre-market. The CFO says the company is off to a good start in 2025 and that free cash flow could be $100 million better. They seem like, you know, small numbers when we're talking about such a big business. Boeing is a $122 billion company. Nonetheless, it's enough to spur the shares almost 4% in the pre-market.
Yeah, to be fair, it was down more than 30% last year, down another nearly 9% this year. So a little bit of good news goes a long way. Let's take a look at these markets.
Yeah, take a look at futures. I mean, we're going to see some really light trading when we get into the cash trade today, and likely we see that with futures as well, which is why you have maybe amplified moves. moves. That's because traders often sit on their hands on Fed Day into the decision and maybe into the press conference as well. Right now, you see futures higher, though, across the board. S&P futures up 0.2%. NASDAQ futures gaining a little bit more, and Russell 2000 futures little change.
And coming up, we are less than 13 minutes to the opening bell. Sitara Sundar of JPMorgan Private Bank says that the growth scare won't lead to a recession. We're going to talk to her next. This is Open Interest.
Check on futures ahead of the opening bell. You can see that we're looking at gains into the open this morning, with the NASDAQ really the biggest gainer right now as tech stocks take the lead. Tesla, for example, is the biggest gainer among stocks worth more than $50 billion. And we're watching, obviously, the fallout from NVIDIA as well and all its various partnerships. But I think the consumer and the economy are front and center as we head towards the Fed.
Sure are. And we're going to get a lot more data this week also, including jobless claims later in the week. But joining us now at the desk, Sitara Sundar, global equity strategist at JPMorgan Private Bank. Investors are struggling to figure out which signals to pay attention to. We were talking about the consumer. Everybody is parsing every little data point that cuts the tape. What about the fundamentals from the companies that are reporting and telling you how they're reacting to the tariff strategy? Are you listening to them, or are you listening to the scary signals under the surface?
So first, thank you so much for having me. I think the biggest thing for us when we're looking at this entire mosaic is to focus on the fundamentals. Like, I didn't think coming into this year that I would be quoting a tale of two cities as much as I have. But the start this year has been giving ammunition to the bulls and the bears. On the bearish side, a lot of the consumer sentiment data, even some of the fund sentiment data that we have been seeing, have shown some deterioration. But the biggest thing that I like to say is that fear and uncertainty are not a fundamental indicator. So what is it that we're actually looking for? What the companies are saying. While we have seen some anecdotes of some softening when it comes to companies within the consumer, at the end of the day, what we're still seeing is this. Strong earnings. Let's not forget that the fourth quarter that we just experienced showed 18% earnings growth, which is really strong and above trend. And our expectations for this year is that 2025 and 2026 are going to have above trend earnings growth. And we're not yet seeing hiring plans dissipate. We're not yet seeing CapEx plans dissipate. And that's what we're focusing on, whether the soft data is translating to a weakening in the hard data. And the bottom line is that we're not seeing that yet. So actually, when we think about this volatility and this uncertainty, we're using that volatility to find those opportunities and to buy the dip.
It's maybe above trend growth, but it's not nearly as strong as we were expecting it to be at the end of last year, right? I mean, we've all been talking to people who are looking for 15% earnings growth in 2025. And now I think the average across the market is for 9%. That's a huge hit to expectations,
especially
right?
At the valuations we were at.
Yeah, I think coming into this year, look, we were below consensus actually coming into this year, expecting 11% earnings growth for 25 and for 26. But at the end of the day, there's always a difference between index level and under the hood. And what we're seeing right now in terms of where we're trying to put that incremental dollar to work is not just at the index level, but finding those disparate opportunities under hood where volatility has created even more of a disconnect between fundamentals and expectations. So where we're leaning into is certain pockets of tech, software over semis, which we can talk about. And the second part of it is leaning into areas of the market where you are trying to build portfolio resilience. Let's talk about where we are. The S&P is up 50% over the past couple of years, even thinking about this correction that we've experienced.
But to Matt's point on the slowing earnings growth, I'm actually less concerned about what analysts think that earnings growth will be and what GDP will actually turn out to be. Today we'll hear from the Fed, and their GDP forecast is something investors are watching very closely. This seems to be deteriorating if you look at a lot of the underlying data as well. If the GDP forecast starts to be trimmed, then don't earnings have to follow? Or are you saying that there are parts of the market that could be immune to that?
So the markets are not the economy. I think that we've seen periods of time where economic growth has been a little bit shaky, but earnings growth and profit has been stable. And we've seen other parts of time, like in 2022, where profits started to deteriorate, markets started to correct while the economy was doing okay. So it doesn't have to be that those two things go in sync all the time. But there are parts of the economy where the return generation is not just coming from earnings growth, but it's coming from dividend growth and income growth at the end of the day as well, and not just focused on multiple expansion. So to the idea of like where we're finding opportunities today, this focus on parts of the market, quality dividend-oriented parts of the market, where even, let's say that happens, something goes bump in the night when it comes to the economy, there are parts of the market that are more value-oriented, that are more dividend-oriented, where they can weather the storm in a more meaningful way. Utilities is an area that we've been excited about, that we've been talking to too, where you have more of that durable dividend yield, but you also have those secular tailwinds when you think about data centers, power generation, infrastructure spend, all of those areas. You can get the best of both worlds.
Have you only got 20 seconds left, but have you had to rotate outside of the U.S. because, you know, you have a global position, right? And the U.S. Is overvalued compared to other markets?
So global diversification is something that we have been advocating for forever. Yes, the shine of U.S. exceptionalism has dulled a little bit, but we do find opportunities within select areas within Europe, some of the multinational companies and the strength there, as well as Japan. Let's think about the corporate governance reforms and the shareholder returns that we're seeing within that area too. We think global diversification is important, and honestly, finally this year, diversification has started to work, and we're excited to see that.
Sitara, great having you on the program. Thanks so much for joining us at the desk. Sundar there from JPMorgan Private Bank. We are still looking at equity index futures rising ahead of the open. Jose Rasco from HSBC joins us next. We are moments away from the start of trading on this Fed day. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are still positive across the board. Russell 2000 futures still up. NASDAQ futures leading the way, again about 0.5%. S&P futures up about 1/3%. You do have Tesla as one of the big leaders today, and we're watching closely a lot of these consumer-focused stocks as well. As we see Williams-Sonoma in the pre-market falling pretty sharply, even after a fantastic earnings report. Down at the New York Stock Exchange, you have Human X ringing the opening bell. Apparently, it's the world's most important AI conference. I thought that was GTC, but maybe I was wrong. It's coming up in April in San Francisco. Merit Medical ringing the opening bell down on the NASDAQ market site, and people have reason to be happy today. It does look like we're going to see equity indexes, at least at the start of trade, in the positive territory. Here you go. The live trade on the S&P 500 up 0.4%. So 56.36 is the level there to start the day. NASDAQ 100 trading up more than 0.5% right now at 19,586. And remember, we're going to see slightly lighter volumes, right? A lot of times traders will turn off the algorithms and actually use real humans to do that work until the Fed statement comes out in the press conference. You can see Russell 2000 futures, little change right now. The small caps not doing a lot. Really not a lot of talk about the small caps, especially when Katie Greifeld is not here. In terms of the stocks to watch, Tesla is snapping a 2-day losing streak, and it's done horribly this year. I mean, it's off more than 50% from its high. Right now, the stock is up 3%, though, on the day. 232. There is, of course, the California license that Tesla received for starting a ride-hailing service. As Sonali mentioned, they're going to do autonomous ride-hailing in Austin, and Elon Musk reportedly buying shares in Tesla as well after the stock has puked half of its market cap.
Is every humanoid autonomous, and is every autonomous vehicle humanoid?
Autonomous vehicles are not humanoid, no.
Oh, okay.
They're just cars.
Well, that's what I'm
Unless
waiting
you're riding
for.
on a humanoid vehicle.
We are waiting for those. But one day in the future. And of course, the reason I talk about humanoids is NVIDIA. And so NVIDIA is climbing well today. CEO Jensen Huang laid out the company's ambition in a speech yesterday, emphasizing that demand for pricey AI chips remains strong. And automation is the future. But of course, it'll take, as Matt and I have been talking about, some time to get to some of those more out there kind of dreams.
All right, let's talk to an actual human. Jose Rasco joins us. He's the CIO for the Americas at HSBC, Global Private Banking and Wealth Management. Jose, it's been a tough ride for those who are long the stock market here. Obviously, we hit a correction. We've bounced back a little bit on the S&P and the NASDAQ, and today tech stocks are leading the way. But what's your view overall on the valuations that we're looking at in these major indexes?
Well, number one, thank you for having me. Number two, yes, I am a humanoid. Thank you for recognizing that. And bottom line is, look, we've corrected some of the what we perceived as excesses in the market in terms of valuations. And we've seen what I like to call relative value plays, where we've seen places like Europe has really rallied and China has rallied as well. And we've seen continued strength out of Asia. We made those transitions weeks ago. That's the good news. So we became more globally diversified. From the U.S. perspective, we like valuations where they are. They're certainly much more attractive. But I think the key thing here is the earnings puzzle, right? We've seen earnings revised meaningfully for 2025. But if you look at earnings for 26, at least the indicators we've looked at so far, not much of a change. So that gives us hope that as these valuations continue to get more attractive, investors will look at the fundamentals and we can, once we get past the terrifying tariffs, we can get back to where fundamentals matter, right? And these exogenous shocks get put in the rearview mirror. Hopefully.
Jose, to your point on tariffs, a lot of people have been watching what is happening out of Washington, but today investors are going to be turning their focus back to monetary policy. And one aspect of that will be expectations around GDP. When you think about that macro story, any potential weakening, what is the read-through to earnings and the stock market?
Well, I think, look, the earnings numbers have been revised meaningfully. I think that factors in more than a fair share for tariffs and even some downside risk to the economy. You can say the odds of recession have risen, and that's what we're seeing in the market. But I think to say that recession is the base case, we're a long way from that. We think growth, remember, Sonali, we were saying at the beginning of the year, at the end of last year, we thought growth was going to slow this year. And that's what we're seeing. So we think growth slows. It makes sense. Our economics team was spot on with that. And that slower growth is going to allow us to continue to like the bond market. So if we see rates back up due to fear of tariffs or inflation, as our strategist Max Kettner said on your show, I believe a couple of weeks ago, that's a self-defeating prophecy. People will snap those up. And I think you'll see investors continue to like the belly of the curve on out as inflation fears get a little muted. But the risk of recession has risen. There's no question. But we don't think it's a base case, no.
Are you not concerned that inflation picks up as well as expectations when these tariffs really set in? I mean, I'm watching closely car prices, motorcycle prices, and you need steel and aluminum to build those things. So if you jack those prices up 25% straight away, manufacturers will follow.
Well, look, and tariffs have multiple effects, right? Not just prices. I mean, prices will go up for certain products from certain countries. There's no question about that. But the other side of that is it also affects margins because the company will not pass 100% of that across. And that's one of the reasons we've seen the cut in earnings. And then we'll see slower growth. And we've seen the market factor that in already. So I think it's not just prices, Matt. It's margins and growth. But the flip side of that, don't forget, is deregulation. And one of the things we're hoping that other shoe, they talked about it a week or so ago, we're hoping more comes out of that. And if you see more on the deregulation side, you see the release of those animal spirits we kept hearing about. We need to see that. We need to see lower energy costs, and we need to see more competition in the marketplace. That's what's going to lead to better inflation, in addition to the whole tech deflation story. But as you guys said it before this interview, that's taking time, right?
Jose, one thing investors are very much struggling with is where to buy. On one hand, we have seen valuations correct meaningfully, as you pointed out. But on the other hand, if you think stocks are going to go lower, even meaningfully lower, you might want to wait. What's the risk that we get lower from here?
But there's always risk of some further deterioration, right? But we think we've seen a meaningful correction here, and we think valuations make sense at these levels, especially if you look at the earnings projections for this year, which is still above trend. And then next year, they're accelerating from there meaningfully. So I think that really is the key for us. So we do like Europe from a tactical perspective. There's an opportunity there. China we like because of the shift in government policy. A lot of these exogenous shocks really hit the markets all at once, right? And then I think the tech sector in particular in China looks interesting. There could be some opportunities with the consumer, but right now we're more focused on technology and opportunities there. And then in the U.S., I would say, excuse me, we continue to focus on those long-term themes of reindustrialization, the nearshoring and onshoring of jobs, the role technology plays. And I know Commerce Secretary Lutnick got sort of pilloried by many people talking about technology and automation and factories. We're not building factories where we're going to hire 30,000 people. We're building factories that are going to be highly automated and highly competitive at a global level. And that is going to help drive profitability and job creation. But it's not going to be jobs first and then productivity. It's going to be productivity, technology, automation, and that's going to drive earnings, and that's going to help lift the market. So we're still positive on a lot of the sectors we liked before. The consumer is going to be a little iffy, but we don't think the unemployment rate moves materially. So therefore, as long as real disposable incomes are still positive, the consumer should not disappear, and that should be better.
Certainly,
tariffs aside, it should be better.
Are watching very closely. Jose, that is HSBC's Jose Rasco. We thank you so very much. Of course, the consumer story has been a wild ride for investors, and that brings us to some movers that are on our radar, because General Mills cut its full-year forecast because it sees a slowdown in demand in North America. You're seeing General Mills down 2.2%, and it's interesting, this comes a day after Pepsi was downgraded by Barclays because of pressures on snack businesses. So this is in part a consumer story. You also are seeing Williams-Sonoma down more than 11% now. Can you imagine? This was a company that raised its dividend.
It beat earnings expectation and raised its dividend, but said over the long term, we continue to expect mid to high single-digit annual net revenue growth with an operating margin in the mid to high teens, and maybe that it wasn't enough for the street. On the other hand, you do see Boeing shares rising. The CFO there says tariffs wouldn't have a material near-term impact on the company, and it is off to a strong start for 2025. So a little bit of a mixed bag in terms of companies out with earnings or any kind of guidance this morning. Nonetheless, we still see the major indexes rallying ahead of the Fed meeting. I should say most of them ahead of the Fed meeting this morning, with the S&P up over a third of 1%.
Yeah, it could be a big day depending on what the Fed says. Right now you have 2 rate cuts priced into the market. There were 3. So if you think about it, if investors were thinking the economy was going to soften meaningfully, maybe they think it will be less big of a drop off in terms of economic activity. That would bode well for the stock market. Let's see if the Fed agrees.
Right. We do get a new dot plot today, so that is one thing to look forward to. And of course, everyone's waiting to see what Jerome Powell has to say, if anything, about the effect of tariffs and mass deportations on inflation and growth. Coming up, big changes at 2 Wall Street titans. We're going to take a look at the job cuts at Morgan Stanley, bonus cuts at Citi. That's next in today's Wall Street Beat. This is Open Interest.
We're a $3 trillion bank. We are significant, so we can support clients in financing. That'll be debt capital markets and leverage finance and the global transaction banking. These are really amazing sort of jewel of the crown type of businesses and the ability to help clients navigate. So in the US, that's what we're going to be focused on, the global transaction banking and the financing. M&A and equities, we were less competitive. So I think, making sure that where we have strengths is where we focus.
And that was Lisa Miguel. She's the U.S. CEO of HSBC, speaking in her first TV interview since taking the role. Remember, HSBC is undergoing a global restructuring, and that includes job cuts across New York, London, and continental Europe. And that brings us to today's Wall Street beat. Because elsewhere in finance, Morgan Stanley plans to cut about 2,000 employees this month to keep a lid on costs. And Citigroup is slashing executive bonuses tied to the bank's turnaround. We're going to discuss it all with the best of Bloomberg Finance, Bloomberg Sally Bakewell, and Sridhar Natarajan. Sri, because you're also breaking this news on Morgan Stanley, the job cuts, yes, we're keeping the financial advisors intact, 15,000 of them, but M&A has not come back as expected. They want to keep a lid on costs, and automation could start to eat into jobs. How significant is this move? We haven't seen one like this in a while.
It's the first major workforce reduction under new CEO Pertchik. I say new, he's been in the job since the start of 2024, but they haven't had an exercise this large since he took over. Now, let's also look at some of the reasoning behind it. Unlike some of their rivals, chiefly Goldman Sachs, which has this military discipline of wanting to cut 3 to 5% of their workforce every year, Morgan Stanley does not do it. And yet, the fact that they're doing it right now does feed into the broader dynamic that, yes, this might not have been a reaction to the market moves. These moves rarely are in reaction to a 1 or 2 week move in stock markets, or necessarily the pause that we're seeing in mergers and acquisitions out there. But it does speak to the idea that at some level, senior executives of the firm perhaps think revenue is not going to grow as fast as costs are growing, and this was the right time to keep a lid on those costs. And that's why you're seeing this action where they're planning to cut about 2,000 people from their workforce.
So that's about 2.5% of the total workforce. And they don't typically do the kind of culling that Goldman Sachs does on a scheduled basis, but usually bankers quit, right? They have attrition normally. Is this just something that Pertchik has to do in place of attrition because they're not quitting this year?
Yeah, I think that this is probably a job environment where a lot of people don't want to face the uncertainty of trying to move jobs or take another job at another Wall Street lender. And amid all the uncertainty over Trump's policies and now we have hearing increasingly how there is a sort of bounce back might not come back in M&A, I think it's a time to probably sit tight.
So there's the other thing going on at Citigroup, too, and I wonder how much of these moves are bank-specific. The idea that Citigroup is slashing executive bonuses that was tied to the turnaround. These are special bonuses. How big of a deal is that? Of course, these were very specific to Citigroup's turnaround, but does it also signal something about the discipline that is required from the banks in this environment?
Well, back office weakness has long plagued Citi. Just when you think that it might be out of the woods, you hear about another issue popping up. And just in July, they faced a $136 million fine from regulators over progress toward their data quality. And now we have just heard that their 3-year sort of bonus transformation plan, about 250 employees last year got about 68% of the target, which is the lowest of those 3 years. So I think that is an indication, along with a number we've heard of lately, that the revamp and this transformation, it's difficult, and it certainly evokes memories of some of the glitches they experienced last year. There were 2 occasions, one reported by us, one reported by the Financial Times, where they did or nearly did send money to the wrong place. And of course, then we had the Revlon issue in 2020 and the fat finger situation in 2022. So Citi, Jane Fraser, she acknowledges in earnings earlier this year that this was the middle point, the waypoint, and not the destination. They still have a lot of work to do, and that's indeed what they said yesterday in the filing about this bonus target.
I wish my bank would send me $81 trillion by accident. This is 2 down arrow stories, Sri. Firing 2,000 people at Morgan Stanley, bonuses getting cut at Citi. Are these indicative of what's happening across the industry? Is this banks turning down?
It is them at least battening down the hatches. When you have the U.S. Treasury Secretary go on TV and talk about the idea that corrections are healthy, you needed this, there's nothing to worry about. There is at least this telegraphed idea that you're not going to enter a period of exuberant stock markets. You already have a lot of bankers talking about these abrupt policy pronouncements, the flip-flopping on tariffs, and lack of clarity on what the ultimate destination is on that policy front. That is forcing deal makers to have difficult conversations with their corporate clients, because corporate clients are on the sidelines. They're all on the 5-yard line. They're all talking about this extended pipeline of deals, but there is a massive pileup because people are not pulling the trigger on the announcement. And at some point, the pipeline gets whittled down, not because deals are getting done, because companies will then have to pivot away from the strategy of a merger to actually seeing how they can improve their underlying business. And that's not good for investment banking either.
All right, Sri, great to have you on the program. Sally Bakewell, thanks for joining us as well. Our finance team there covering the firings at Morgan Stanley, the cuts in bonus payments over at Citi, and we're obviously going to keep our eye on Wall Street very closely. Sonali will be doing that as usual for you. I'm looking at the markets that are climbing a little bit, just 20 minutes into the session right now. We're looking at gains that are getting more solid, with the Russell 2000 now matching the advance that we see on the NASDAQ 100. So tech stocks really pulling us higher today, but the broader market doing quite well as we get ready for Jerome Powell's decision. We're expecting no change, obviously, from the Fed, but we will get a new dot plot, and we will get an answer to whether or not he feels like sharing his view on the changes that tariffs and deportations make in the growth outlook.
Yeah, certainly a lot to look forward to this afternoon. I do want to point out that as we get into the trade, one more bullish signal here is what is trading higher. So remember, yesterday we were talking about defensive names really leading the way. In fact, today you have Infotech, discretionary, and not just Tesla. I mean, you have 40 out of 50 members of the consumer discretionary index higher. So a bid really back into some of the parts of the market that were a bit harder hit due to growth fears. Financials getting a bid, real estate getting a marginal bid, though it's pretty much flat. But staples, that was your defensive trade. Healthcare, your defensive trade, those are actually down.
Yeah, if you click into discretionary, consumer discretionary there, you'll see Caesars, Carnival, Royal Caribbean, Norwegian. So these are places that consumers had been less likely to spend, and I guess they're happy to gamble and go on cruises now. Coming up, UBS strategists say the U.S. growth scare will not inhibit the global equity market. They see a 9% upside for the global index, so more growth globally. We'll talk more about that in our strategy of the day. This is Bloomberg.
It's time now for our top calls. Some of the analyst action in focus this morning. First up, Tesla getting raised to a buy at Cantor Fitzgerald. The firm says the sell-off is a buying opportunity ahead of catalysts like the rollout of robo-taxis later this year in Texas. Tesla up 2.5%, getting a breather this morning. But next up, Oppenheimer is downgrading a number of financials today, including Goldman Sachs, which is no longer a buy at the firm. And the firm says there are no signs of an M&A rebound for the group, thanks to tariff threats and trade uncertainties. You do still have Goldman pretty much flat on the day, but down on the year. Finally, Restaurant Brands, the parent company of Burger King and Tim Hortons, getting upgraded to a buy at Argus Research thanks to its growth potential, Matt. People are still going out to eat, it looks like.
Yeah, well, at least for now. We'll see what happens when prices start to go up for everything else. UBS strategists expect the MSCI World Index to climb an estimated 9% in 2025, saying preconditions for a bear market are not in place, and the growth scare in the U.S. can be balanced out by growth elsewhere. And I think this is the key, right? They're talking about the global index, the MSCI all-country index, and we've been watching this rotation out of U.S. stocks and into European stocks, as well as you can see the MSCI China is absolutely on fire there. So a lot of reasons given by Andrew Garthwaite and his colleagues in this note, but they say, number one, AI should boost productivity. I think that's interesting that they list that as their first reason globally.
Yeah, I also think that what's interesting as part of the trade is how much is poured into defense. You've been pointing this out since the very beginning, but if you looked at an S&P sector breakdown here of what's performing, Rheinmetall is performing well above everything else in that index, and now you start to talk about valuation once again.
All right, coming up in the next hour, Guggenheim's Jim Millstein joins us on the Fed, the economy, M&A, and much more. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today. And coming up, it's decision day. The Fed is expected to enter wait-and-see mode, stuck between lingering inflationary pressures and mounting growth concerns. And before that decision, we're going to survey the investment climate with Jim Millstein. He's co-chair of Guggenheim Securities and a former Treasury Department official. Plus, Ukraine's Volodymyr Zelensky said he's going to have a phone call with President Trump today. We're going to hear from White House Special Envoy Steve Witkoff.
All right, let's get a check on what's going on in the markets. Just let's see, we are 4.5 hours away from the Fed's press conference. We'll get the decision, obviously, before that, and the dot plot, importantly, but we're not expecting much out of really either. S&P 500 right now up about 0.6%, so markets climbing to session highs a half hour into the trade. The Nasdaq 100 leading the way up 0.7% as tech stocks and Tesla are rising. Tesla leading the Mag 7 higher right now. And you see the 10-year yield still at 4.31. Really been stuck in this range now for the past couple of weeks, so holding at 4.30.
Yeah, it's pretty remarkable, especially when you think that there are two Fed rate cuts priced into the market right now. There's a disconnect. All eyes are on the Federal Reserve because investors are waiting clarity on the Fed's future moves. Take a listen.
It's really not where you want to be as a central bank. They're going to be revising down their growth forecasts. They're going to be revising up their inflation forecast.
The first thing would worry me if suddenly they do what they did on inflation in the past, which is start changing the definitions.
I think the Fed's just going to be looking at the numbers and seeing, are prices coming down or going up?
Stick with what you saw in the data coming in at the end of the year, and keeping this wait and see mode.
I suspect that they will be tempted to be data dependent, and if they're tempted again to be data dependent, the risk of a policy mistake is much higher.
I do think in terms of making any commitments about the path of policy is probably one they're going to be stepping back on at this point.
Joining us at the desk, Jim Millstein, Guggenheim Securities co-chairman, a legend on Wall Street and in Washington. Jim was the Treasury Department's chief restructuring officer under President Obama and a very good person to talk to when people are very worried about the economy, frankly. And so, one thing is that you see investors pricing in now 2 rate cuts this year. There were 3 priced in. So the outlook is still a little bit sour, but maybe not as dire as before. You see so much under the surface because you're also a restructuring advisor. Do you think that the fear is warranted?
Well, I think as the chair said at the last interview he did, he's looking to the Treasury Department and to the White House at this point to see the direction of their policy. Tariffs are a big change in the potential economy of the United States and the world economy. And so that will influence both short-term price pressures as well as economic activity. So I think he's kind of frozen for a while until he sees really where we're going with tariffs and how the rest of the world reacts to those tariffs and whether we get a growth slowdown as a result of retaliatory high tariffs being imposed here and retaliatory tariffs being imposed outside.
Can't we already tell? I mean, Jim Farley, the CEO of Ford, said these tariffs or the threats thereof are causing chaos and costs. And it seems to me that in the next round of CPI, PPI, and PCE, we're going to start seeing that shine through.
Yeah, I think just anecdotally, I think some of us are already seeing prices go up on the things we buy as a result of suppliers and sellers getting ahead of it. Yeah, I think, in the short run, tariffs are an increase in the price level, but thereafter, it may just stay at that level. So the rate of change may not be great in 2026 as it will be in 2025 when the tariffs are imposed.
Well, but Jim, all this, all this uncertainty in not only tariff policy, but we don't know what's going to happen with regulation. And tax cuts are in question, right? Mass deportations. That seems to be affecting everything from small businesses. When you look at the NFIB, no expansion, to Morgan Stanley and Citi saying like the M&A bankers and the IPO guys that we have not really necessary right now.
Yeah, I mean, listen, I think one of the two big pieces of legislation that President Trump got through in his first term was his USMCA, the tariff deal, the trade deal between Mexico and Canada.
It's the greatest trade deal anyone's ever seen.
According to the White House, yes. And as a result, I mean, that's been in place now for 7-8 years. And U.S. manufacturers, which is the sector that the Trump administration now wants to promote, U.S. manufacturers laid out their supply chains in Canada and Mexico based on the rules of the road established by the USMCA. So, that no one should be surprised that they were surprised by the threat of imposing 25% tariffs on Mexico and Canada, our two largest trading partners. And why are they our two largest trading partners? Because the USMCA created a roadmap for how to take advantage of relatively lower wages in Mexico and take advantage of relatively lower commodity prices in Canada to set up your supply chains for domestic manufacturing.
Aside from tariffs obviously creating a lot of havoc in the market, that's fair to say, on tax cuts, one question I have, this was supposed to be one of the biggest parts of the pro-growth agenda, that and lighter regulation. But how likely is it that we see a lot of those promises come to fruition? And if we don't, does it stifle that pro-growth story?
Well, let's first be clear and level set, right? So the extension of the 2017 Tax Cut and Jobs Act is basically the status quo ante. If it isn't extended, you would have a tax hike on households. The corporate tax cuts were made permanent, but the household cuts were not. So if they don't extend them, you're going to get a tax hike. But if they do extend them, it's just the same tax regime we're in today. Now, President Trump, as he campaigned, talked about further tax cuts, no tax on tips, no tax on Social Security, no tax on overtime. That would, the estimates are all over the place as to what that cost to revenue would be, but let's assume it's somewhere between $200 and $300 billion a year. So over the 10-year period, another $2 to $3 trillion worth of incremental debt for those tax cuts at a time we're already running a deficit equal to 7% of GDP. So let me just stop there a little bit, because this is really, to me, I guess if you're a hammer, everything looks like a nail. If you're a debt restructuring guy, everything looks like a need for a debt restructuring. Today, our federal debt to GDP ratio is basically 1-to-1. We're running a 7% of GDP deficit this year, okay, which means the debt is increasing by 7% a year, whereas the economy has only been growing at 2 to 3% a year. So we're basically becoming more indebted over time because the growth of the economy is not outpacing the growth of the debt. So there's a massive need for what we call in the trade fiscal consolidation. We need to get our house in order and create revenues closer to spending.
Well, and they're hoping to get those revenues with tariffs, I guess. In terms of the cuts, I mean, Scott Bessent has this 3-3-3 plan, but it seems so unrealistic to get the deficit from 7% down to 3% if you're only able to find like $58.26 in waste and fraud, right? Because they're not attacking Medicare and Medicaid and military spending. They're trying to fire people at U.S. aid.
Right. But also, guys, especially as growth is expected to slow, I think that's a part no one's talking about here. That how do you grow into that if the GDP forecasts are being revised downward?
The tax cuts and deregulation
so let's be fair to Mr. Bessent. Yeah. He's talking about a 4-year trajectory to get the deficits down from 7% of GDP to 3% of GDP. He's talking about goosing the growth rate of the economy to 3%, not in the sort of low 2s, high 1s that we've been in, and trying to moderate inflation by having more energy production. with oil in the 60s, you're not going to get more energy production here in the United States. It's just not, return on capital isn't there for that. So let's put aside whether or not that's the best way to deal with inflation. How do you goose the growth rate? Well, the theory of the administration is that deregulation is going to free animal spirits in the business community, that the tariff walls are going to create a surge in domestic investment to produce, because behind those tariff walls you can be more competitive against foreign competition. The problem with all of that is it takes a lot of time. Deregulation is going to take a lot of time. The rules that are currently on the books that they want to get rid of, the agencies actually just can't say done by executive order. They have to go through a rulemaking process. They have notice and hearing, and they have to unwind the regulatory state is going to take, even if they move with lightning speed, is going to take a year or two to fully unleash the animal spirits. And with regard to setting up new production facilities in the United States and reorganizing our supply chains, that's a multi-year effort. So, and you're doing it against the backdrop of high tariffs, potentially retaliatory tariffs, which could be a growth slowdown, as you say, Sonali, which means that tax revenues might shrink in the short term, and God forbid we have a recession. And then not only do tax revenues shrink, but expenses go up because of all the counter-cyclical programs we have to ease the pain of a recession.
All right. We are fortunate enough to have you with us for another block.
Well, let's see about that.
So,
You're staying right here.
You're going to stay right here, Jim, and we're going to talk more about this and about bankruptcies, because as you mentioned, you are a restructuring expert. I want to quickly get a look at some of the stocks that are moving right now as we hit really session highs on the indexes. The NASDAQ up, looks like more than 1% at this point. You can see a Tesla rising 3%, NVIDIA rising 2 and change. Now, it doesn't make up for the drops that we saw yesterday, and not nearly for the drops that we've seen so far year to date, but it's doing quite well. In terms of reversals, Intel is another one because it had been gaining, and now you see Intel getting a 5% haircut on the day. So those are your big tech stocks that we continue to watch for you, and we'll get back with more with Jim Millstein after this break and ahead of the Fed. This is Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Boeing shares are jumping in the early trade after the plane maker's CFO spoke at the Bank of America Global Industrials Conference in London. Although the company has some worries about the availability of some parts, investors were cheered when he said the firm's off to a good start this year on its success factors. Starboard is preparing for a proxy fight at Autodesk, according to a report from the Wall Street Journal. The activist investor has been urging a shakeup at the software maker for about a year, and last August, Starboard pressured the board at Autodesk to reevaluate the performance of the company's CEO after accounting issues at that company to make AutoCAD and other software. Purdue Pharma has filed a new Chapter 11 plan with the U.S. Bankruptcy Court for the Southern District of New York. The company is pledging to give creditors, including U.S. states and other parties, more than $7 billion in cash to compensate victims of the opioid crisis. According to a statement, a new public benefit company will be created after Purdue is devolved, and the Sackler family will lose ownership interest and have no role with the new firm. Sonali?
Speaking of bankruptcies, we have Jim Millstein of Guggenheim Securities still with us here on set. And I want to pull up BCY on the Bloomberg terminal because you could see just how much you're seeing bankruptcies, particularly loaded to the consumer discretionary sector. And something about this that is a bit deceiving, Jim, is something we were talking about in the commercial break here. Actually, you're not even seeing the bulk of the pain in the Chapter 11 filings. You're seeing it in the way that creditors are working out the way they're trying to keep companies alive through additional debt that is coming at high interest rates, frankly. Even if you see the Fed cut twice this year, does that relieve these companies of the pain they're struggling through of refinancing at these higher rates?
No. The answer is no. So you look at the credit markets and the corporate credit markets, there was a huge surge of refinancing activity that went on when rates were low in the early post-COVID period, when the Fed had driven rates back again down to virtually zero before the bout of inflation. Most corporate debt has a maturity of 5 to 7 years, so we're now at the end of the maturity of that wall of refinancing that went on there. So now we've got a new wall of refinancing that's required at much higher interest rates. So even if the Fed knocks 50 basis points off the low end of the curve, the short end of the curve, the far end, the belly of the curve out in the 5 to 7 years zip code, companies that did their financing back in 2020, 2021 are now going to be refinancing in a much higher interest rate environment. As the uncertainty, the general macro uncertainty creeps into the credit markets, you're seeing a slow, not dramatic, but a slow uptick in spreads in the non-investment grade market. And so both higher base rate and higher spreads are going to create higher interest burdens.
Why are spreads so tight right now? I mean, especially if you see an increase in bankruptcy or a concerning absolute number of bankruptcies, why do you have spreads, even junk spreads, so tight?
There's just a tsunami of credit availability right now. There has been, the growth of the private credit businesses, which is unrelenting and continuous, which in some ways really recycling money out of the insurance industry, which used to be big bond investors and continue to be bond investors, into a series of specialist funds to do their underwriting. There's plenty of bank liquidity available.
And private credit.
Yeah.
No, as I say, private credit.
Yeah.
Well, to that end, is this masking some of the pain that's really under the surface? What are you seeing? Because when you think about it, banks say, well, consumers are fine. But Bank of America, an average FICO score is well over 750. It's almost 800 for many of its credit lines. And so you're not really seeing the American consumer there. You're not seeing the painful companies that are maybe being turned away from a JPMorgan type firm today.
Yeah. So you take the 4 years of pretty high inflation. And while there has been wage growth to compensate, that wage growth is moderating. So you're really seeing the consumer starting to be pinched. And that's why you're seeing the first set of distress show up in consumer-oriented companies. Again, this is with plentiful credit availability and a change in the capital structures, particularly in the middle market arena, where you have not so much bank finance, but private credit. And private credit is usually one or two lenders. So when a company gets into trouble, even a private equity sponsored company, you can have a conversation like this about what are we going to do?
And nobody else knows about it.
What are we going to do about it? And so there's an awful lot of what we call liability management exercises going on in private conversations between a private credit fund and a private equity fund, or a private credit fund and a family-owned business.
So I've been bringing up these stats a lot lately that bank balances have declined over the past 12 months back to pre-pandemic levels, this across all income groups. Wage growth has slowed over the past 12 months across all income groups, and that Americans' inflation-adjusted debt is rising past 2019 levels across all income groups. And yet everyone says never count the American consumer out. And I've been doing this for 25 years. It's a good thing to say, right? Why is the American consumer so resilient, and does that continue?
It's about credit availability, and just look at the federal government, right? As long as people are prepared to fund, a $1.7 trillion deficit, the Congress can continue to spend with abandon. As I said earlier, I think we're coming to the end of that cycle because we're at the point where the debt's growing faster than the economy. But as long as there's the last lender there willing to, lend you that dime to finance your spending, you're going to take it when the alternative is, a restructuring.
Yeah, or no iPhone, right?
Yeah, they're giving them away. You just have to sign a contract.
Yeah.
Obviously, a lot of things to watch around the corner. Jim, we thank you so much for your time. Of course, that is Jim Millstein of Guggenheim Securities, watching for everything that's weakening under the surface and how significant it may be. But still ahead, Gilead Sciences is getting hit after a report that the Health and Human Services Department is thinking about reducing federal funding for domestic HIV prevention. Just another place you're seeing funding pulled back. We're going to give you details next on Bloomberg Open Interest. And it's time now for Social Climbers. The company's making waves this morning. First up, Gilead is falling after a report that the U.S. Department of Health and Human Services is planning to cut federal funding for HIV prevention programs. Wall Street weighing in, saying that the reported funding cuts only represent a modest impact to this drug maker. Next, Roku jumping today after Trump Media and Technology launched its Truth Plus streaming app on its channel. Roku up more than 8.3%. Finally, the RV maker Thor Industries getting a downgrade at Citigroup. The firm cites reduced confidence in its recovery because of consumer headwinds. Super interesting, Matt, to see what's happening in those consumer stories today.
Yeah, especially in the RV space. I want to get one of those. But obviously I can't with the uncertainty in this economy. Let's get a check on the markets right now. We do see gains across the board in terms of the equity indexes. So you can see the S&P 500 right now up 0.7%. The NASDAQ right now up a little bit more, 0.9% as tech stocks and the Mag 7 kind of lead the way into this Fed meeting. Of course, we're watching very closely to see what Jay Powell has to say, as well as getting the new dot plot and the SEP. Coming up, uncertainty is starting to rise among business owners. We've been seeing that over the past couple weeks. We got a read on how owners are feeling with Andmore CEO Jon Pertchik. He joins us next to talk about his B2B business. This is Bloomberg. The latest NFIB survey shows uncertainty is growing among small business owners. The amount of owners who said now is a good time to expand fell to the lowest level since April of 2020, just after COVID hit. For more on how businesses have to plan ahead or dealing with these headwinds, we're joined by Andmore CEO Jon Pertchik. Andmore offers physical B2B marketplaces that end up being the biggest trade shows in the United States. We're talking massive trade shows, John, right? Like 21 million square feet of space for business owners who need to make forward planning. How are they dealing with the current economic environment?
Thanks, Matt. Thanks for having me. Yeah, we're the largest marketplace that brings buyers and sellers, buyers being retailers, sellers meaning manufacturers of furniture, gift, and apparel. We've got 21 million square feet in Las Vegas, High Point, North Carolina, and Atlanta. And we do reflect the sentiment of consumers through those anticipated buying behaviors of those retailers from our manufacturers. January, your last segment talked about the resilience of the American consumer. January, which was our most recent major markets, the buying power, the amount of activity was actually extraordinary, which gives at least a glimpse into how people were feeling as of January. Now that may have changed, it may be evolving, I don't know. But as of the latest indicator we have, sentiment was pretty positive.
You know, one of the things that you have at these trade shows is furniture. I think that's a really interesting place to look right now. I grew up myself in Paramus, New Jersey, and the highways are lined with furniture stores and car stores. And when things get rough, some of these stores tend to go away. It's really brutal, but it's an economic indicator in a lot of ways. People are having a hard time with homes, John. People are having a hard time buying things to fill those homes. What does that part of the market look like for now when you talk to business owners?
Again, I'll tell you from the activity we've seen just in the last couple of months, again, January, our next major market is in April. And so far, the activity leading up to that, the bookings and what we expect attendance will be are pretty positive. So what we saw in January tells a bit of a different story. There was a level of optimism. Again, the buying power, the amount of activity we saw at that market, those markets, I should say, plural, multiple markets in January, winter being one of our biggest, that and July are our two biggest moments, was quite positive, which would suggest a different perspective of the American consumer. Than what we're sort of seeing most recently in some of the news related to tariffs and otherwise. So I still have a pretty positive outlook, and the conversations I'm having, more just anecdotally with some of our customers, have also remained fairly positive.
We were looking at an inflation map a couple of days ago, and you can really see it on the coasts, but it's not as bad in the middle of the country. And likewise, with the tax changes that we've seen really in Trump 1.0, the coasts were hit much harder than the middle of the country. Do you see a regional breakdown in terms of the businesses coming to your marketplace?
That's a great question. It's a little early for me to say and to get that specific geographically. What we saw in Atlanta and Las Vegas in, again, January being our most recent major activity, levels were very positive in both places. And Vegas would tend to draw from sort of the West Coast and to some extent inland, meaning like Scottsdale, Phoenix, and Atlanta more the East Coast, but spread. It will draw from the Midwest and other places too. So it's a little hard for me to discern and give you anything really firm on that basic point.
Jon, if you're feeling really positive about things now, despite kind of what some of the more underlying concerns show in economic data right now, then do you feel the opportunity to expand more? The idea of being greedy when others are fearful?
I'm all contrarian in terms of it. I've made a career partly out of expanding when others are contracting and just in general. So I'm a fan of that often. We are focused on expanding, and we don't own any real estate. As I said, we own 21 million square feet. We have a show where we don't own real estate in New York, and I expect we're going to be starting expanding there. We're very focused on that, and I think we have some other expansion opportunities. So partly based on my relatively more optimistic view than others, I think we do have opportunities to expand. Separately, we're in the middle of the beginning, first or second inning of a major transformation in Andmore. I have a whole new senior team I brought on. I'm big on codifying my plans. I have a transformation playbook, leveraging a little bit of AI, leveraging something called WOW, which is an acronym for ways of working, doing things differently. So I'm really optimistic that we're in a unique spot, partly because of the changes that are underway within the company and partly because of some of the growth opportunities we have.
How does the income statement look, if you don't mind me asking? What about your financing needs? Is there any possibility of an IPO in your future?
Who knows? I mean, I'm here to create long-term value. But by the way, I would say with all this uncertainty that's been out there lately, I'm very happy I'm not running a public company right now. My last company was a Fortune 500 public company. I'm very happy to be running a private company. So I won't reveal the details, and I know you're not asking for them. But creating long-term sustainable value, which is what I'm really focused on, could lead to all sorts of optionality, whether it's an IPO, that could be in our future, who knows, or something else. But it's a really exciting time at this particular company.
Jon, great to get some time with you. Thanks so much for joining us. Jon Pertchik there of Andmore. They put on the largest trade shows we can say in the U.S. and possibly the world. Jon, great to spend some time with you. Thanks so much. Let's get a check on what's going on in these markets as we head toward the Fed. Right now, S&P 500 index up about 0.2%, and we do see the tech stocks kind of leading the way here, with the Nasdaq 100 up about 0.75%. In terms of the stocks that are on the upside right now, Apple adding the most points, Nvidia a big gainer, Microsoft, Tesla, Netflix all doing well, and you can see the 10-year yield not doing a lot at all. In fact, we really haven't seen any volatility in treasuries lately, which I think is pretty fascinating.
Yeah, it is. It's been very volatile. 430 is the new normal. And also, just really quick comment about the market here. A lot of people have been watching that first half hour of the trade to see if it sticks, basically. And today we're not only sticking, we are higher. Let's see if it lasts through the day. Of course, there's been a lot of intraday headlines, but a little bit of calm feels good after as much selling as we've seen. Some stocks moving under the hood this hour. General Mills has been cutting its forecast, citing retailer inventory and a snacking slowdown. This is not the only place we're seeing that, Matt.
I wish that was the case at my house.
I mean, I just finished a pint of ice cream myself last night, so I'm with you. But also interesting here, Signet Jewelers just soaring today. Whoa. Wow. The owner of K Jewelers, these are diamonds, of course.
And gold.
And gold says sales are recovering after a disappointing holiday season. I wonder if people are out there falling in love and stuff like that.
Probably not. It's interesting, I think, that gold is trading over $3,000 and holding, right? It's been a few days now, and it's right now trading for $3,030. Williams-Sonoma is one we were talking about this morning because the company, which owns also Pottery Barn as well as West Elm, but we know them for their kitchen products mostly, it reported fourth quarter profit that was far better than the street was looking for and raised its dividend, I think 16%, which was more than Bloomberg had forecast as well. And nonetheless, the shares are down 12%. Concern really about the consumer as they put out a forecast that really didn't excite the street.
One thing that's kind of disappointing about that, too, is that dividend story is a huge part of this market right now. Investors want to see it. But in this case, even a higher dividend is not helping the stock shake off consumer fears. Now, coming up, we're going to talk about what's happening in geopolitics because President Putin is operating in good faith, according to White House Special Envoy Steve Witkoff. We're going to bring you more from our interview and the latest on Ukraine next. This is Bloomberg Open Interest.
Let's get to Washington now. President Putin rejected President Trump's call for a 30-day ceasefire in Ukraine after the two leaders spoke yesterday. President Trump called the talks Moscow only agreed to limit attacks on energy infrastructure while demanding a stop to the flow of weapons and intelligence to Ukraine. White House Special Envoy Steve Witkoff spoke to Bloomberg and gave us some more detail. Let's listen in.
What was agreed between the two presidents was, and it was at President Trump's suggestion, that there be a cessation of attacks on energy infrastructure from both sides and civilian infrastructure for that matter. Also, working towards a Black Sea moratorium on hits on naval vessels and freighters carrying grain and things of that sort, and ultimately that would evolve into a full-on ceasefire, which is a bit more complicated because there's a 2,000-kilometer border, there's Kursk, and there's a lot of details that go into that. But with regard to your question on some of the reporting with regard to the Russian drones last night, I have it on good information from a telephone call I had before I went on this show that President Putin issued an order within 10 minutes of his call with the president, directing Russian forces not to be attacking any Ukrainian energy infrastructure. And any attacks that happened last night would have happened before that order was given. In fact, the Russians tell me this morning that 7 of their drones were on their way when President Putin issued his order, and they were shot down by Russian forces. So I tend to believe that President Putin is operating in good faith. He said that he was going to be operating in good faith to the president yesterday, and I take him at his word.
So, Mr. Witkoff, is your understanding that as of today, energy facilities, energy infrastructure will be off limits?
That's my understanding, yes, ma'am.
Do you think the next stage potentially, as we get the roadmap towards a 30-day full ceasefire, potentially geography should be off limits, like drones hitting Kyiv?
You know, I can't speak to that. I think the idea behind a 30-day ceasefire, first of all, we made more progress yesterday than has been made in the last 3.5 years. The two leaders actually talked and committed to cessation of attacks on energy infrastructure and civilian infrastructure. They talked about reviving the Black Sea maritime agreement that had been negotiated several years ago and never really implemented. Those are monumental things, and they're trust-building things as well. And I think beyond that, they also went into how you would put the finishing touches on a full-on ceasefire. That full-on ceasefire has a lot to do with this 2,000-kilometer line that where the Ukrainians are lined up against the Russians. It's complicated. There are different battlefield conditions in various spots. That's for the technical teams to figure it out. And they're going to be meeting in Saudi Arabia, I believe, beginning Monday and Tuesday. So lots of progress happened yesterday, and it happened in large part because of President Trump.
Let's stay on this story because, of course, it is a live one. Joining us now, Bloomberg's Tyler Kendall in Washington. And, of course, to recap a little bit here, you have Steve Witkoff denying that Russia broke an agreement to not attack Ukrainian energy infrastructure, and Anne-Marie asking him whether certain places should just be absolutely off limits here. He said that progress made in the last 24 hours was better than progress seen in the last few years. But the definition of progress here, how much is that up for debate right now as they look to a lot more lasting peace and certainly a more significant ceasefire?
Well, Sonali, you're exactly right. There's now these firmer questions about exactly how firm, really the only tangible deliverable that we got yesterday when it came to a supposed halt on attacking energy infrastructure in Ukraine. We're expecting to potentially get some more details even later this hour. According to the White House, we are expecting that call against Ukrainian President Zelensky and President Trump is expected to have already started. In the wake of this, Zelensky says that he will be urging U.S. and its allies to try to ramp up, exert more pressure on Russia in order to get them to the negotiating table in what Zelensky has called good faith. He's floated, for example, trying to tighten sanctions additionally. That's something that this White House really hasn't ruled out at this point, but it does remain to be seen if that is something that the U.S. would do, considering that the White House so far, Steve Witkoff there, President Trump, have really tried to frame this call as a positive step. We heard from the Kremlin this morning, for example, saying that the U.S. committed on that call to a, quote, gradual normalization of relations between Moscow and Washington, something that we know the Kremlin was keen to look into. But importantly, we have to keep this all into context. Yesterday's call really did fall way short of expectations from the U.S. when it came to their main deliverable that they were going after, which was to get Russia to agree to that 30-day ceasefire plan. Up next, we are looking ahead to those anticipated talks next week in Saudi Arabia. We are expecting the maritime potential ceasefire to be the next thing on the table as we look ahead to that.
Surely Zelensky, Tyler, wants Russia out of all of the territory it's taken, maybe with the exception of Crimea, since that's been annexed since 2014. Do you have any indication of whether or not the White House is insisting that the Russians vacate the Ukrainian land they've moved into, or whether or not President Trump is willing to give that to Vladimir Putin?
Well, that is one of the biggest questions, particularly after President Trump said that they were already talking about dividing up the assets, as he called it, alluding to territory concessions and also critical infrastructure there. Now, according to a tracker that we trust from the Council on Foreign Relations, about 20% of the country right now is currently under Russian occupation. Zelensky said earlier this morning that he has no intentions of recognizing any Russia-occupied land as Russia's occupied land moving forward, that for him is going to be a red line there. We're going to have to wait and see particularly how that point moves forward here as we learn more about, for example, one of the things on the table, whether or not a huge nuclear power plant could be up for discussion as they continue these talks.
Tyler, we thank you so much for all of your reporting and, of course, for keeping an eye on the situation over the last 24 hours and over the next 24. That is Bloomberg's Tyler Kendall. Now, coming up, the Fed decision just hours away. We're going to tell you what you need to look for, what you're going to expect next. This is Open Interest.
Get a check on the markets almost an hour and a half into the trading session. We still see green arrows across the board. Not the session highs, but better than the lows on the S&P right now at more than 0.5%. The NASDAQ gaining 0.2% as tech stocks together with Boeing really lead the way here. I think Eli Lilly, Boeing, and then the Mag 7 are all adding points to the S&P 500. You can see the 10-year yield there, very little changed, and that's no surprise as oftentimes markets are light on volume and making big moves before a Fed decision. Of course, the latest Fed decision is due today at 2 p.m. Eastern, and we're going to get a press conference half hour after that. Investors see almost no chance of a cut today, but they will be focused on any revisions to the Fed's forecast. Remember, we get the SEP today as well as the dot plot. Joining us now is Bloomberg Chief Economics and Policy Correspondent Michael McKee out of Washington. So, Mike, what are you going to be focused on? What are you watching for?
Well, we'll watch for anything that Jay Powell says in his news conference that might be taken as something of a Fed put. Wall Street is anxious to have the Fed backstop them, but I don't think Jay Powell is going to say much of anything at all. They don't want to do anything that would bring attention to them or mess up monetary policy right now. So no change in rates, of course. And then the dot plot everybody's looking at, they may go to one cut, but probably makes sense for them just to leave it at 2. As you mentioned, not much in the SEP either. The only thing that they might do today, but that wouldn't be very controversial, is to pause or halt QT while the debt ceiling is being negotiated in Washington. A lot of people on Wall Street think that might wait for the next meeting.
To your point about maybe going to one cut, what would that signify? The reason I ask is because the market is still pricing in at least 2 cuts through the end of this year. Is that really just signaling that inflation is going to stay too high for them to have meaningful change, even if the economy slows?
Well, that would be the takeaway, and that's why they may not do it. There's 2 possibilities. One is that they think inflation on its own is stickier than they thought and won't be coming down as fast, or they think the tariffs will raise inflation, and they probably don't want to get into that debate. So I would assume that their default is going to be, at this point, stick with 2, stick with basically the same economic forecast, because they don't have anything that tells them they're going to be much different.
Hey, Mike, in terms of the dot plot, how important is that to you? They seem to always say, you know, here it is, but don't pay too much attention to it. And it seems to me that it's quite valuable in forecasting what the Fed plans to do.
Well, Matt, you just put your finger on the problem there. The Fed would argue with you that it is not a forecast. It's 19 separate estimates of where the federal funds rate will be under the conditions that each member of the Open Market Committee thinks will obtain at that time frame. So if you think inflation is going to be X and unemployment is going to be Y and growth is going to be Z, then what would be the proper Fed funds rate at those criteria? And so they don't like the idea that it's a forecast. It's a much unloved item in the Fed's arsenal, but they don't see any way to get rid of it at the moment. So they just have to keep reminding people not to take it literally.
So hang on, Mike. It's each member's forecast put together, and we're encouraged not to think of it as a forecast.
Right, essentially, although they would say it's not even a forecast from each member. It's just kind of a guess at where things would be under their forecasts for the economy. But what happens is we take the median, but there's a wide range of views on what it could be. So the cone of uncertainty is really wide. And so they think that Wall Street makes a mistake by taking this as a promise or a strategy. It's really just here's the possibilities ahead.
Mike, we thank you so much for your analysis. We're looking forward to your coverage this afternoon. That is Bloomberg's Michael McKee in Washington. Stick with Bloomberg for special coverage of the Fed decision and news conference. A host of guests, including Diane Swak of KPMG and former New York Fed President Bill Dudley. And of course, we're looking at a market that's up, including much of the Magnificent Seven. And a good day in the markets. We'll see if the Fed starts to change a little bit of that course.
Absolutely. Tech stocks really gaining for the most part today, with the exception of Intel. This is Open Interest.